Well, this is called Missing the Benchmark, and we are going to cover rate of return. People are worried about how much they actually earn on their investments. Um, there's a way to look at performance and a way you should not look at it. And one of the things that's a real major impact is human reaction to what's going on in the market. So we're going to touch on all of these in this session. My name's Don Creech.
And I am Perry Sykes. Welcome to the Investor Resources Podcast.
So many people think the only return, their return is the only issue as far as determining success. But reality and what you hope for are often disconnected. They're disconnected with reality because
They are.
humans are humans and they're not the market.
It's always going to be true. The humans are humans and they're not the market. And if you're tying everything to any specific index, and pick your index. If you want to be, I'm going to beat the Dow, or I'm going to beat the NASDAQ, or the S&P, or the Russell 1000, 2000, whatever it is, you're not going to be there all the time. You're never going to beat an index all the time. And it's not really that important. What's important is that you have a strategy you can stick to, and a strategy that's going to deliver returns that will let you get to the goals that you're investing for. That's all that's really important. And to get sidetracked worrying about which index you're beating or not beating can really get you off target. And that's really not the point. Beating any index is never the goal of any investment portfolio. It's because there's something you want. You're trying to buy a house, you're trying to retire, you're trying to make sure in 20 years you can put your kids through college. Whatever it is, you've got a goal out there. That's what you want to get to. It doesn't matter if 9 out of 10 weeks you're beating the S&P 500. That's just a distraction.
Well, in reality, Perry, people don't invest to beat the index anyway. That's what they say they want to do. But when you look at how they actually invest the money, they answer a series of questions, either with their financial advisor or on their website with their
Sure.
brokerage firm. And when they get done, they end up in a balanced portfolio of some degree, whether it's 60-40, 50-50. And by default, they're saying, I don't want to beat the index because I am diversifying my portfolio away from the index. Now, if I want to beat the index, I can't go invest in other stuff that has nothing to do with the index. When you stop and think about it, you will say, of course not. If I want to beat the stock market and I invest in bonds, I'm not going to beat the stock market in bonds, except occasionally when there's a severe protracted bear market and bonds do well. And even that, we now know post-COVID, is not always the case. Just because stocks are going down, bonds don't always go up. In fact, we are now working our way through what will be the 5th year of a bear market in bonds, though it's possible that by the end of the year, bonds might finish up, but they are just barely flirting with breaking even in the first 4 months of the year. So how do you do that? Well, if you're in a balanced portfolio, you go talk to your advisor or you call the advisor at the website and he says, well, you look at the stock portion. The stock portion is doing better. Well, yeah, right. But you wanted to beat the stock market, not with just a little bit of your money. You wanted to beat it with your account. And as you said earlier, that very rarely ever happens. We end up when we use a benchmark, we often assume that we had a starting point. I started investing in 1985. And so since 1985, the stock market's returned X percentage point. And I'm half of that, or I'm a third of that. Well, what's wrong here? I mean, I obviously had a bad advisor or I had a bad plan. There's something wrong. Well, one of the first things that's wrong is your return calculation assumes you had all your money at the beginning of the time period that you're benchmarking. And you didn't. I've never met anybody who didn't add money to their account as they got older and they had more income and their bills gone away and the kids went away. We have more money to invest at that point in time. And benchmarking that money against when you started is a fool's errand.
And it's
Uh,
important to see that. It's important to see that they're not, your portfolio is not the same thing as any index. And all those indexes, they've got rules they operate under. They have buy and sell triggers, often way behind what anything a normal investor would deal with. And to say, well, that's what my target is, just doesn't make any sense, because you're not going to tolerate, when the tech bubble busts or the great financial crisis and there's these massive drawdowns, you're going to get out of the way. You're going to make a move. And those indexes never play defense. They never ever try to get out of the way. And so in an up market, you're always going to lag because they're 100% long. They never play defense, and that's not the way most people's portfolios are set up. So you actually shouldn't be outperforming that index. And if you are, you may be taking substantially more risk than you think you are. And that's the important part to get a grip on, because if you're taking excessive risk, that's never a one-way street. That always means that double-edged sword, that risk factor can cut that portfolio right out from under you. And then there you are again. Everything was swimming along, just you were looking great. You were going to get all your goals met, and then all of a sudden half your money was gone. That's a real possibility if you never say, well, maybe what I started with is not where I should be today. And that's the important thing. You have to be adaptive. You have to be willing to change with the market, change with where the money's going. And that's one thing that pie chart will never do.
well, changing with the market depends upon having an adequate source of data that you rely upon and a set of rules on how to make your decisions.
You
You,
bet.
you mentioned the bear markets. We had the tech bubble that burst in 2001 and took a couple of years to bottom out. And if you were in tech stocks primarily, you took a very long time, took more than a decade to get just back to even. And then the great
Sure.
financial crash, that one, the S&P took about 7.5 years to get back to even. And we end up with what's referred to as hindsight bias. And the human emotional factor to losing money is very painful, much more so than gaining some money.
Absolutely.
And we make bad decisions. It reminds me actually of a phone call I had recently from somebody who had been referred to me, and he said that he had a lot of friends who'd been in the market the last decade and they lost it all, and he did not want
Yeah.
to do that. And I said, well, I
Right.
understand that, but that's basically the problem of the cat on the stove. When a cat sits on a stove, on a hot stove, and he'll never go back, it also means he'll
Right.
never sit on a cold stove because he
Right.
thinks he learned a lesson. And investors are often the same way. I've
Yep.
had people tell me, well, I lost money in X and I will never do that again. Well, maybe they lost it because it was the wrong timing. Or as you were just referencing, they had the bad risk allocation. They put too much money into a particular asset class or
Sure.
category, and or they had no rules for getting out. One of the major rules of being a successful investor is not losing a lot of money. And how are you going to do that if you are just sitting through every market wiggle? Uh, at the present time, markets are crashing. Well, we're not yet prepared to call it a crash, but it
Right.
certainly
Right.
feels like that. This is the fastest decline in a very short period of time for the S&P 500 in the last several decades. It's setting some new records on the downside. It feels more severe than it actually is in real numbers, depending upon your asset allocation.
Sure.
But our whole world in managing client money is, where are we now? What's going on recently? Does this change anything in our basic decision matrix? If our decision tree says it's time to sell or time to buy, that's what we do. We don't wait around and argue that, well, that was a really good idea. And the guy I heard on the TV or the radio made a lot of sense. So I think I'll just hang on. Well,
Correct.
that many people do that, but it makes a lot more sense in meeting your objectives, not the benchmark, but your objectives, that you have a set of rules that said, if this is going sideways, I'm going to get out.
And that's so, it is so important. And that's one of the things, like you said before, Don, that when emotion gets involved, say something's been doing really great in your portfolio for 8 or 10 years. It's like, well, I'm not going to sell that now. It's just going to, the assumption is it's just going to turn around and continue doing great indefinitely. It's just going to keep going up because it has. That's just not the way it works. Back to your cat on the stove. Just because that stove was cold the last 5 times you sat on it doesn't mean the next time it's not nice and hot. So you have to really take the temperature of the market all the time, figure out where things are moving right now, and then make adjustments based on that, not on how things have gone. And if you have that pie chart, standard, highly diversified asset allocation model, that's all it is. It's just a historical look at what has gone on, and it's got no reading on what's coming up. And when it's starting to say, look, I'm out of step here, this is not working for me, and it doesn't look like it's going to, you really need to be prepared to make a move. And that's where you need to have those rules in place that say, hey, you know what? I'm down some here, and all the trends are negative. I'm going to get out of the way of this right now and wait for it to turn around. Not walking away forever. Just going to wait until money's coming back in here. These are increasing in value, whatever they are, because right now it's going south, and I don't have to ride this to the bottom. And that we just think that's a much better way to approach it.
Well, and you just mentioned money's not going in here. Well, that happens to be part of the problem with the current market. That's
Yeah.
something that most people
Yep.
don't worry about. They don't know what to look at. But what we do look at is whether or not we have both institutional and retail investors putting money into or taking it out of the market or out of sectors.
Right.
Institutionally, particularly, managers will rotate from one sector to another depending on where the business cycle is. When the economy is slowing down, several sectors usually do better. Utilities often does better in a weak economy. They have high dividends. They're stable dividend payers. They require stable financing, which they have lined up. You have consumer staples. People
There you
need to
go.
buy bread, butter, milk, and eggs, and that happens whether the time is good or bad. So those are areas, and then healthcare, because healthcare costs, particularly with the baby boomer population aging and
Right.
requiring more demand, healthcare is another sector that often does well during slow economic times. Well, do you have rules that actually identify the shift in money going from someplace else to those sectors? Or when it's over and things are getting better, money moves out of those sectors into other areas like technology and financials and discretionary spending areas. Well, that's a normal rotation, and abandoning one sector for the other or de emphasizing one and adding more weight to another asset class inside your portfolio is a rational process. But it requires that somebody pay attention to it. It's something you can
Yep.
do. It's not rocket science. Software is readily available. In fact, I just finished reading the recent copy of Stocks and Commodity Magazine, and they did their annual analysis of software and brokerage platforms, trading platforms.
Right.
Which ones are the voted the best ones and second best? It was an interesting article to see that the software we're using is ranked right up at the top of the list in each of the categories that we use in our business. So it's important not to get tied down to a specific hard item that says this is working or this is
Right.
not, because markets are dynamic. Things change. They will be different next year than they were last year. Well, and
That's it.
certainly this year, 2025, is different than any prior year in a
Oh yeah.
hundred years. And
Yep.
that's the
It's so it's
frustration with
it
management in
is.
this kind of environment is
It
we
is
have.
so different. Yep. And it's so important to look at it and say, well, we've got some rules here that say this is what we're going to do, and then it takes the discipline to do it. And that's the advantage. That is a huge advantage over um, the buy and hold diversified pie chart, which is going to make no changes no matter what's going on. There, the mantra is, well, in 50 years you'll never know this happened. It's like, That's true. I won't be here anymore. So that's not going to do me any good, though. So that's what we're trying to avoid.
Well, you don't have 50 years to accumulate your assets. So once you do start accumulating and once you have them, it really is time to figure out how are you going to make decisions. If you don't have that process we do, you can contact us. There's contact information that follows right here. Thanks for being with us today.